Hi there, John from Popnalls. Over the years, myself and my team have helped thousands of clients, from new startups to multi-million pound businesses. Now, we wanted to put together some small clips for you as a new business owner, which will hopefully help you in the first few years of trading. So let's jump into them. So one of the main things to consider when setting up your company is who are going to be the shareholders and who are going to be the directors. So a director has to act in the best interest of the shareholders, and quite often for owner-managed businesses, the directors and the shareholders are the same people. So with regards to why is this so important, the main reason that this is crucial is once you've set the company up and the company has commenced trading, the company has a value. When you then transfer shares to other people at a later date, because for example, you might say, I don't want to be a shareholder anymore, I want to give it to my son or my daughter, that gift has got a valuation, and potentially there are tax consequences because you're shifting the value of the company to a new person. It's therefore important to get the share structure correct from the start. And this is why it's so important to speak to an accountant before you commence trading and get the best possible advice. So one of the most complex parts for any business owner is the share structure. For example, the share structure allows you to say who can vote at board meetings, or who can receive dividends from the company. Now, there's lots of different ways of structuring a company, and there's lots of different shareholding options available to you. So for example, some people have different classes of shares, which allows them for potentially different rights, or allows them to issue different dividends to different shareholders. Now, this is something where you should always take professional advice before setting up the company, because once you have your shareholders in place, it is very hard to transfer the shares between each other at a later date. Potentially there are tax charges with transferring shares, and potentially there's stamp duty and capital gains tax to pay on these transactions. So VAT registration is another area that should be considered when you're setting up your new company. Legally, you have to register for VAT if your turnover for the previous 12 months is in excess of £85,000. Now that said, there are occasions when registering for VAT, even if your turnover isn't that high, is beneficial. So some of these examples would be, for example, if you're carrying out new build work, which is 0 rated, you can then reclaim the VAT on your expenses. There would be other occasions when potentially, for example, if you're working for standard rate suppliers all the time, so you're working for businesses all the time, that registering for VAT might benefit your business because you'll be able to reclaim VAT on expenses like accountancy. So I know lots of people have mentioned previously about dividend waivers and things like that you can basically use to issue different dividends to shareholders. Dividend waivers in reality do not work, and they've been challenged many times by HMRC, and they're also challenged on basically, does the company have the retained profits to issue those dividends? So it's a really complex matter and something that you should probably avoid at all costs. And again, this is why it's so important to get the share structure correct from the very start. So one of the common mistakes that many business owners make is they introduce their car into their limited company. Now this is a real problem because they've made that car a commercial vehicle and potentially a company car. By doing that, they will end up paying tax at P11D tax on that vehicle, which will result in a high tax charge for them and possibly the company. The P11D tax charge is worked out on the list price of the car when it was brand new. And it's also worked out on the CO2 emissions. So if you have for example, a Range Rover or something like that, that's 20-year-old Range Rover, you are going to be paying an awful lot of company car tax on this vehicle. We therefore would always recommend that you speak to an accountant and make sure that you are reclaiming the mileage or reclaiming the vehicle costs in a sensible way. So one of the other ways we can help new businesses is we can help them go through their pricing and their budgets. One of the key things for all new businesses is obviously to make money and make sure that they keep themselves above water when it comes to cash flow. We have a lot of different tools and softwares that will allow you to monitor your budget, your pricing and your cash flow for your business. So quite often when a new company is formed, the directors will introduce money into that company. Now this money that's been introduced would be classed as a director's loan. A director's loan is basically a loan from the director to the company, and it can be repaid at a later date. This repayment would be tax-free. There would be no tax to pay on the monies received on repaying that initial loan. The only thing I'd like to say on director's loans is potentially there's some serious tax consequences if you take money out of the company when the profits weren't there to do so. And this can result in there being an overdrawn director's loan account. Now, if you have an overdrawn director's loan account at the year end, at the company's year end, potentially there will be additional corporation tax to pay, and potentially if the company was to ever go into liquidation, you've lost your limited liability. It is therefore so important that you basically take proper professional advice regarding your director's loan account. So one of the most common things that we discuss with new business owners is payroll. So a lot of new business owners, they come to see us and they say, John, I can't go on the payroll, there's no point me having a payroll, I don't know how much profit my business is going to make. And in a lot of circumstances that's correct. However, if this is your only job and you have no other income, there could be certain benefits by going on the payroll of the company from the very start. So these benefits, for example, could be that you are making NIC contributions for things like state benefits, or that you're making NIC qualifying years for state pension. You're also potentially making you're increasing your corporation tax allowable expenses. So you've got potentially a tax loss or a larger tax expense that you're allowed to offset against your corporation tax. And you're also crediting your director's loan account if you aren't going to withdraw the money from the company. So basically what this means is that you can pay yourself the payroll, and in 5 years' time, when your company's making a lot of profit and you've got the money in the business to repay yourself, you can repay that director's loan account tax-free. This is why payroll is so crucial to get correct from the start, and we would definitely recommend that you speak to an accountant about this before you commence trading. I hope these videos have been of use to you. If you'd like any specific advice or further detail, then please get in touch and we'll be sure to help you out.